Hey everybody, this is Alex Merced from alexmerced.com, and this is about what goes into a price in 1 minute. So what are all the different costs that a business has that goes into what makes things more expensive? Now yes, if you increase taxes are a cost. You increase taxes, things are going to cost more. But also, if you start creating regulations that create legal liabilities, that increase legal liabilities, that's going to increase the cost of liability insurance. That's going to increase prices. If you increase, if you do all sorts of different regulations on labor, that's going to result in increasing costs or investments in automation. But those investments in automation, at least in the interim, will increase costs and result in possibly price increases later down, depending on several factors. But there's also costs of putting aside money for a rainy day. There is making sure that you have a profit to be able to raise capital in the future. Because if your profit margins aren't enough to be competitive against other companies, then you won't be able to raise capital in the future to grow the company to employ more people. So my name is Alex Merced from alexmerced.com. Hey everybody, my name is Alex Merced from alexmerced.com, and net worth is not cash. So a lot of times people will say, hey, the Walton family has billions and billions of net worth, and they should use it to pay their employees more. The bottom line is net worth is not cash. It's not like the Waltons have billions and billions of dollars just sitting around in cash in a money bin like Scrooge McDuck. What net worth is the value of all your assets. And if we assume that we sold all your assets at what we think they're worth and paid off what we think you owe, what you have left over. So billions is a lot. But it doesn't necessarily mean we can just get that money, because because most of what the Waltons family have is Walmart stock. And you're not gonna, even though maybe some people are buying it at a price today, if you were to sell all of the Walmart stock into the market to raise cash, you're probably not going to sell it at the same price that it is now. So you're not going to be recovering the same billions that you think there is there. On top of it, the Walton family is not the same thing as a Walmart corporation. So my name is Alex Merced from alexmerced.com. Have a great day and enjoy. Hey everybody, my name is Alex Merced from alexmerced.com, and this is why profits matter. Okay, it's important. A lot of people will sit there and try to argue that, oh, well, if the company has any kind of profit, that's exploitation, or if they have a huge profit, it's bad. And the bottom line is that profits generally represent a lot of things. One, a profit allows a company to save money for a rainy day, allows it to invest to grow the company, which means it can hire more people, create new goods and services, and continue to grow as a company. Because a company that isn't growing is shrinking. There is no sort of, we're going to stay the same size forever. That's not how it works. On top of that, okay, a higher than normal profit margin is a signal to other people in the market that there's more work to be done in this particular industry, which incentivizes competitors. And more competitors eventually end up bringing that down as they figure out what's the best way to bring goods to the markets and services. Generally, if a profit stays very large for very long, then there's risks and other costs to entry that aren't being considered. My name is Alex Merced from alexmerced.com. Hey everybody, this is Alex Merced from alexmerced.com, and I want to talk about trade surpluses and trade deficits. So trade surpluses, where we are selling more goods than buying, is not a good or a bad thing. And trade deficits, where you are buying more things than selling, is not a bad or a good thing. Either one, if that's all you did, would be bad. And if you never did the other, that would be bad as well. Because if all you did was have a trade surplus, you kept selling stuff to the rest of the world but never buying anything, eventually you'd have all the currency and no one else would be able to buy stuff from you any going further, and that would cause a problem. And vice versa, if all you did was buy stuff and never sold anything, you would run out of money. So bottom line is, that's why it's called the trade balance, and the trade must balance. So when a country buys stuff from another country, that money does have to be used. So if we buy stuff from China, that currency has to go somewhere. So even if they don't use it to buy our stuff, as far as goods and services, it could be used to buy assets such as stocks, bonds, real estate. So at the end of the day, it all works out for everybody. Hey everybody, this is Alex Merced from alexmerced.com with why tariffs are bad. At the end of the day, any tax on anything is bad because you're imposing a cost, and that cost has to be paid by someone. And it's not always very clear who is the person paying. So when you put a tariff on a foreign good, that can be dealt with into a couple different ways. One, they increase the price, which is more likely to happen. And then what's going to happen is that it'll either reduce the consumption of that good, or consumers will just pay more for it if it's something that there's not really any alternatives for. And that is essentially bad for everyone. But at the same time, it creates a political problem where countries retaliate and impose their own tariffs, and then what you have is this battle, this race to the bottom, where basically people keep imposing costs, and eventually both countries are worse off because they're both buying from less efficient producers, which means they're wasting more resources to produce the same amount of consumption versus instead of being more efficient, so that way more people can buy more with less. My name is Alex Merced from alexmerced.com. Hello, my name is Alex Merced from alexmerced.com and talking about why a unilateral trade deal is a good idea. Usually you hear people talk about multilateral trade deals, which means many countries at the table. The problem is, the more people you have at the negotiating table, the more complicated the deal gets, which means chances are the more cronyism, the more corruption ends up in the deal. There's bilateral deals where it's between two countries. It's a little bit simpler, but at the end of the day, there's still a lot going on, and it still gets complicated, it still gets filled with corruption. A unilateral trade deal just means a country says, you know what, we're just going to lower our tariffs, we're just going to lower our quotas. And if you do that across the board, what happens is that your country just naturally becomes a better country to do business in, and businesses will want to be in your country. Because it's not just about two countries directly with each other. Any company does business with many countries. So if you're the country where doing business with other countries is the easiest because you put the least barriers, businesses are going to move to your country, and it's going to force other countries to do the same. So unilateral is the way to go.